Welcome to a brand new edition of Inside Out, and this is our Diwali special show. Usually, we take a deep dive into companies and individual stocks, but this time, Nigel, we are taking a deep dive into the markets. Before we get to that, wishing all our viewers a very happy Diwali to you as well, Nigel, and your family as well.
Well, happy Diwali, Sonal, to you as well as your family, and wishing all our viewers as well a very happy Diwali. But talking about markets, well, from last Diwali to this one, we've seen a bit of a subdued performance for the Indian markets. We're sitting with a cut of close to around 4.5 to around 5% or thereabouts. Though we need to note that in the global backdrop, we've still done pretty well because many of those global markets, they are sitting with much larger cuts in the similar period. Well, the small cap index, it's taken a sharper knock from the Indian markets, that is. And the reason that the Nifty is under pressure is because one of the pillars of the market, that's the tech-related stocks, well, they have seen an absolute big underperformance. And giving it company on the downside has been the Realty Index, which has also been a big underperformer. But let's talk about the big outperformers. There are two sectors in there. One is autos and FMCG indices. They have done really well in the past 1 year or so.
As we can see in the moves that these sectors have seen. But Nigel, what about flows? We've been talking about the big FII flow picture. Tell us more about that.
Well, the FIs, they've been the heartbreakers. No two ways about that. You know, they broke up with the Indian markets, it seemed, from last Diwali, and they started selling. In the last 1 year or so, well, they've sold close to around $28 billion. In terms of what have they been selling? Well, obviously sectors where they have the highest ownership. Namely, you have the banking and financial names as well as tech. 97% actually of their selling has been accounted for by these three big sectors. And 11% has been accounted for by oil and gas space. The reason, though, that the Nifty hasn't really fallen apart is that domestic flows, they have been rock solid, as is evident with the DII buy number of close to 31,000 crores, with 65% of that being accounted for by mutual funds. Well, that's about the flow picture. But Sonal, the retailers, they have really been putting in the money. Tell us, how has that been?
Okay, Nigel. Well, I actually looked at a longer time frame. So 3 sets of data. How is the shareholding across NSE-listed companies in the last 2 years? Let's look at DIIs. It includes domestic mutual funds, insurance companies, banks, financial institutions, pension funds, and it was at 14.35% in June 2020. But since then, it has been coming down. The lowest level seen at 13.13% last year in September, and then started moving up to the levels of 14.06%. So basically, it has been stable. But now, let's look at the HNIs and retail participation. Retail, that is individuals with up to 2 lakh investment. But first, HNIs. From 1.84% in June 2020, it has been consistently moving up. So the percentage held by HNIs across all NSE-listed companies over quarters has risen to 2.12%, 2.21%, but it has slightly come off from those levels to 2.08%. Now, let's talk about the winner here. That is really the retail investors. So they held around 6.74% in the NSE-listed companies, inched higher to the 7% mark in just the next quarter, and it has been able to hold on to those levels. And now in June 2022, the shareholding is at 7.33%, and this has been increasing since. So the last known number is 7.4%. Interestingly, on the domestic front, the share of retail investor in companies listed on NSE is almost the same as the share of domestic mutual funds. The other way to look at it is the SIP flows. Look at it in September, almost at 13,000 crore rupees, and this has been the highest, at least if we look from last Diwali to this Diwali. Last November, SIP flows were around 11,005 crore rupees, which gradually increased, hit the 12,300 crore mark in March, and then saw some decline. But then it has been around the 12,000 mark for a long time, and in September, it is at 13,000 crore rupees. And the increase in retail participation can also be witnessed in the way demat accounts have increased. We've spoken about it often, but it's almost a 5 times increase from the pandemic levels at 10.25 crore rupees. So this Diwali, bigger pataka is definitely the retail investor. But Nigel, that is about the retail flows. A lot of themes that worked, right? You want to highlight them as well. Which are those?
Well, few themes that did play out in the past year include paper, as it was part of the unlock trade as people went back to school, went back to work as well post the lockdown. Paper prices, they remain elevated, and better products mix, well, that's what kept a lot of these stock prices elevated. The China plus one, Europe plus one theme as well has kept chemical stocks in business. And finally, occupancy levels have increased. The average revenue rate per room, well, that as well surged as vacations and staycations, well, they picked up steam as well. But Sonal, those are the themes that worked in the past year. What about in the coming year? What does the street believe? Which themes can work?
Well, there are some sectors, Nigel, which are expected to see strength in the next Samvat as well. Let's start with the one expected to be in the fast lane, autos, where strength is to be driven by the CV space in particular, where CV cycle is expected to maintain its momentum and volumes after hitting pre-pandemic levels that is expected in FY23. Remember, even September car sales came in at an all-time high. The next one, which we all like to do, is travel and eat. This gained momentum in how post-COVID. The average revenue per room for some big names saw a big increase versus pre-COVID levels. For Taj, it was up 22%, Lemon Tree up 20%, Ginger up 34%. Even for QSRs, Jubilant Foods revenues and EBITDA high by more than 30% versus pre-COVID levels, and even Westlife saw 41% increase versus revenues and 77% for EBITDA. What's working for them? Well, they have newer avenues of revenue, and at the same time, they have changed cost structures, which is helping profits. Consumer habits of traveling have only gained momentum. This, of course, has some risks, increasing competition and inflation impacting demand. Now, after Gaadi, Khana and Ghumna, let's talk about defense. The stocks have done phenomenally well, and the opportunity size of 9 lakh crore rupees over the next 10 years could ensure that outperformance continues. How is this expenditure split? Well, naval capex is expected at 4.5 lakh crore rupees, so this size is huge, and the Atmanirbhar push is putting a lot of focus on this sector. BFSI. This is one sector many market participants are betting on. The improved outlook in economic conditions and pickup in credit growth. Definitely something everyone is watching out for, Nigel.
Well, thanks a lot for that, Sonal. But let's get to that part of the show there where we invite two very, very special guests who are joining in. Mr. Basant Maheshwari, Auto and Portfolio Manager, BM Wealth Advisors, and Viraj Mehta, MD PMS Equirus, who join us on the show. Hi, Basant. Thanks so much for joining in, in the studio, as well as Viraj. Thanks so much for joining in. Well, we've got to listen to your big themes that you want to give us for the next year or so. Basant, you go first. I believe mid-cap cement is something that you like, particularly the ones that are trading at a sharp discount to replacement cost. $50 per ton. There are few companies in there. What do you have for us?
I mean, if you put up a fresh plant, no one knows cement better than you in the journalism industry, Nigel. So if you put up a fresh plant, it takes $100, $120. You want to buy a cement plant, you have to pay $164, $164 being the specific number. But these companies are trading at 50. So just take 2 seconds and put a mathematical flavor to the entire thing. If you are making an ROE of 15-20% on $164, because that's what somebody's written a check for, it comes to about $30, right? If you got a smaller cement plant, you don't sell cement at half the price. You sell cement at a certain discount. So if you're making $30 for a large cement plant, and the smaller ones are available at 40 and 50, this math doesn't add up. So this has to go up sooner or later.
I've got very few companies in there that trade at around $50 per ton. There's Orient Cement in there. There's a Sagar Cement in there. Yeah. Give us a rough number. Are we zeroing in on the correct ones?
No, I don't know, but anything below 50 is good enough. Okay. Any company trading at below $50 EV per ton is good enough. Yeah.
So some of these names would definitely fall in the list, right, Basant? Okay, so let me go across to Viraj as well. Since we are talking cement, the next theme we can talk about, of course, is real estate. These two are connected. Viraj, some of your top picks are also in the real estate space, proxy to real estate. Tell us more about that, because we've been talking about real estate being in that up cycle. Do you expect it to continue since the interest rates have been rising, and at some point in time, home demand won't be as much? What are your thoughts here?
So thanks a lot, first of all, and happy Samvat to you and all your viewers. So how we think about real estate is a very, very localized market. And some of the pockets where we are looking is places like Pune and Bangalore, where salaries of some of the affordable or middle class families have gone up significantly. And till we see retrenchment in that segment, the change in salaries have permanently happened. Now, growth from here might be difficult to grow in salaries, but that permanent change in salary, which has happened once, will lead and continue to lead real estate growth in those cities. And which is why I think we need to be far more pocket specific. We need to be far more theme specific in terms of which companies or which real estate companies are we looking at.
Okay, and that would be for you?
So for us, we own a small company known as Kolte Patil, who is one of the largest developers in Pune and who is a small developer in Bombay. And demand for them will continue to do well, and they will have large segments of launches over next 2 years. We are expecting them to launch between 6,000 and 8,000 crores of new projects over next 2 years. which will lead to significant pre-sales and re-rating for this company. And today you can buy the whole company for less than 2,700 odd crores.
All right. So, Viraj, I believe that on the real estate play, you're looking at two out there. One is Kolte Patil that you mentioned, and the indirect play would be Polycap. So, we've noted down your views. But, Basant, coming back to you then, you know, IT and mid-cap IT and large-cap IT, there are a lot of debate out there. You know, many people think that mid-cap IT ran ahead of itself. But you're saying two of these mid-cap companies, they're coming together and they're going to be larger. So, you rather play that theme. Tell us more about that.
See, I think the large cap IT sets the ceiling for valuation, and the mid cap IT generates the EPS growth. So you could always say that a mid cap can never trade at a higher valuation to a large cap. But when the large cap is growing at 8%, buying back equity, and the mid cap is growing at 20%, you'd rather go and look at the mid cap. So here I can tell you in our small case, we own Mindtree, so which is a mid cap, trying to almost a large cap now once they get merged. I think, look at the results. The results are good enough. But then you'll say there's recession in US and there would be recession for 2 more quarters and 3 more quarters. As long as this recession doesn't turn into a depression, I think all these companies are going to recover well. And that's the proper way of looking at it. There's nothing in the result, there's nothing in the commentary. So one management can be lying, two could be lying, but all IT companies, no one said that the roof is falling on their head. So I think you should go with what they are saying.
Okay. So that is about your mid-cap IT pick. Viraj, let me come to you. And this is my favorite topic as well, snacking, which is one of your top picks as well. We are in the Diwali season, so let's talk about snacking because that is something where the market is bullish. So what is your pick in that case and why? What's making you so optimistic here?
So if you look at the snacking industry, it can essentially be divided into two segments. One is in-home consumption, which is namkeen. One is out-of-home consumption. Out-of-home, and these two segments had great divergence in last 2 years because in-home took a tailwind and out-of-home took a headwind because people were not traveling. Now that has changed. We believe out-of-home consumption should significantly recover. And they were hit by raw material pressures due to palm oil going to 150. So all those headwinds today are turning into tailwinds, both in terms of growth and gross margins. And which is why we believe that companies who have really tightened their belt in this industry, like a Pratap Snacks, which have gone from tier 3 distribution model to mostly tier 2 distribution model, which have eliminated one chain, who have increased their PTR, from closer to 4.25 to 4.35. All of this will play out, and we believe if the raw material remains where they are, they should essentially report their highest gross margins and EBITDA margins over the next 4 quarters, which will mean that they are bound to generate highest ever profits. And even today, after 3 years of listing or 5 years of listing, the stock is at a 40% discount to its listing price. So there is a lot of room for upside that we think exists in this company and business.
All right, Viraj, let me come back to you. Sonal said that she's very fond of snacking. I'm sure she's very fond of jewelry as well. Now we'll have to find out whether or not she gets some. But I believe you have a theme from there as well. But it's not the the Titans, the Kalyan jewelers that we normally talk about. Tell us more about the company.
So we own, and the disclosure here is that we own all the companies we discussed. And we own a large company known as Thangamel Jewelry. They are one of the largest retailers of gold jewelry in South India. They own 52 stores there, but they are not in Chennai. They are in tier 2 and tier 3 towns. So they are one of the largest in Madurai, Coimbatore, Dindigul, and people from Tamil Nadu know their brand. The company is growing from essentially 1,500 crore revenue 2 years back. They should end this year between 2,800 crores to 3,000 crores. And more importantly, they are improving their product mix with better diamond-studded jewelry and silver jewelry. They're one of the highest inventory turnover. They've hired one of the best consultants, Goldratt, which were consultants even for Titan. And with the market share that these guys are gaining from the unorganized industry due to mandatory hallmarking, we believe there is a long runway of growth for this segment. And considering some of the peers who trade between 2 times sales to 8 times sales, depending on which listed peer are you looking at, this guy is available even today at less than 0.7 times sales. So there is both runway of growth in top line and earnings and in PE rating.
Okay. Okay, I hope the message is received by the person who has to buy me jewelry, but we'll just slip into a short break now. We'll discuss more themes for the new Samvat on the other side. Stay tuned.